So it was started to help companies be able to automatically reconcile and balance, both whether they're doing a cash basis or accrual basis accounting.
Okay.
So in MBA, you learn in marketing that you have for employees what's called hygiene needs. Hygiene needs means you have to pay them enough for them to be able to eat and put shelter over their heads. And once you can take care of their needs there, then you can give them benefits they'll participate in, 401k plans, a gym membership, etc. Whatever you're offering, if their hygiene needs aren't met, they're not going to participate in this extra stuff you're doing, and you're thinking you're doing something cool to motivate an employee, but they're not taking the benefit because they can't get past this need they have. In accounting and with credit cards, it's the same thing. Accountants are stuck by the fact they can't meet their hygiene needs, meaning I've got to reconcile and tie and do my books, get the matching principle on timing wise, and because I'm stuck in this little box trying to go out and just get my books on, they're ignoring all the other things that are happening to them with credit cards. So when we wrote the product, it was to help accountants automatically balance, tie, reconcile, and do their journal entries. The byproduct and the benefits became that when that happened, what we began to see was these trends and issues the industry is creating. And it's led us to 8 strategies that a credit card creates for a business. And a business that doesn't have a policy and procedure and handle those 8 strategies will lose the game somewhere in credit cards. There will be losses and fraud that's going to impact 100% of the businesses not addressing those 8 opportunities. 8 strategies. Those strategies include things like your theft and chargebacks, your fraud on declines. In declines, you now have do not honors that are increasing at a pace due to the industry that, due to its lack of ability to get information and the pace at which credit cards are increasing, and it's going so fast, banks are just throwing it into miscategorization just to get it off their plate, and that popular category is do not honor. 40 to 50% of what's being categorized in there is a straight up fixable transaction and money you should get that the industry screwed up. And so you have your KYC, you're knowing your customer financially. A lot of companies will do a KYC to validate that the person they're dealing with, especially online businesses, is a real person by validating a LinkedIn page or a Facebook or Twitter, some Instagram, etc. The iron is just because you validate somebody's real doesn't mean you understand how they're financially going to impact your business. Just because they're real doesn't mean they're not going to commit fraud or do bad acts or behave badly towards your business. So the credit cards show us the behavior they're doing. So we get to see the trends. Every time you bill them, they do a chargeback. Well, why would you keep selling to them? Statistics show in the industry that 85% of chargebacks are cardholder fraud. They purposely are consuming the good and service with the intent of not paying for it and lying to their bank saying, that wasn't me. With that said, a business that doesn't address chargebacks allows, or the stats also show, that that cardholder that gets away with committing fraud or theft against your company in a chargeback, unaddressed by your business, leads that person to more than likely coming back and increasing the amount that they buy your products and services, and within 60 days are 900% more likely to be back and abuse you again. Your company has to know the chargebacks, has to address that person in order to stop them from coming back and abusing you again. So that is a benefit of the product. That has nothing to do with your reconciliation, but has a lot to do with the future behavior or an impact to your business or future loss you could take from the behavior of a cardholder that if you handled appropriately, you can thwart and stop from happening in the future. One of the fastest growing cards we've talked about is prepaid cards. Prepaid cards have a fixed amount to them. So the terminals today, most are smart enough to try to capture what's remaining on a transaction, but they're not smart enough to put back the output telling the merchant that we didn't get all the money. So we call it a forced discount program because businesses are discounting their product without knowing they're doing it because say a gift card has $20 left on it and you sell them $30 worth of product. The terminal picks up the $20, prints out a receipt, but in the fine print on the receipt, it will say it only got $20, but nothing printed on the terminal that says, hold on, we're still short $10, we need to get that. Now that's not everywhere. About 20% of the terminals today are smart enough to do that. 80% cannot handle the partial auth and leaves the merchant either completely blind, not knowing they didn't get their full amount, or doesn't even warn them all, even on a receipt. Now, worst of all are the ones that go out, can't handle partial auth, and declines the whole transaction when part of it could have been done. It just voids it and you lose the wholesale. But would you rather lose the wholesale, get some of it? Do you have enough margin to cover the fact you were forced into a discount because you got lost in that transaction was for? So we begin to now display and show them, you put in a transaction for this, you collected this, you did not get all your money. Once again, it should be an accounts receivable and a decision for that business to decide how they want to handle that. Are they going to go after that person in the future? Are they going to leave it in receivables to send a collection letter to them to try to collect on the remainder of their transaction?
Yeah.
Or are you going to write it off? Again, if you still don't know that variance, you're going to do your accounting books thinking you had a $30 sale and you're going to book $30. You have no idea how to tie that over to the end because it all batch processes your bank. The reality is you have $20. That's what went, less your fees. You want to write off or discount that sale and a contra sale of a refund or discount of $10 to at least not pay tax on the $10 you didn't collect. So once again, it's either handing the receivable and writing it off or going after the person, or at least doing it on your books so you're not paying tax on revenue you thought you started with or that you generated versus the cash that finally made it to your bank.